Hey everyone, welcome back to Fiscal Voyage. My name is Felix, and today's video we're going to talk about two stocks that I bought this week, two dividend growth stocks that I bought that are undervalued and are expected to continue to grow in earnings and continue to grow as dividends and continue to eventually price appreciation. So we're going to cover those two stocks in today's video. So first, what I want to do is show you the buys. So I bought 30 shares of OTX at $31.34. I did this on the 6th of May. You can see here it was about $940. And then I also bought this DOX. This is actually a new position of mine. I just opened a new position in this stock. I bought 30 shares at around $79.64 at $2,389 investment into this stock. So we're going to cover both of these stocks and why I bought shares. So first off, let's go to the fast graph. You can see here OTX right now is going for, let me actually change this, put it into American NASDAQ here. OTX right now is going for $30.13. And you can see here the stock actually had a drop in after the earnings announcement. So that brought the stock drop down from like around 35 to 30 bucks. So that's why I picked up shares at what I did, because if we look here, first off, let's look at the company. You can see the company has been on a tremendous growth path over the past 20 years or so. You can see here, double-digit growth every year. Except 2015 and 2016 slowed down there at 3%, 2%, but it would still continue to grow it, and then double-digit growth, and then single-digit, and so I think this is what's going on now. That why the price dropped, because analysts are expecting a negative 16% earnings decrease from 2024 to 2025, but back to double-digit increase for 2026. You can see here the credit rating is not that great. It's not investment grade. It's just a double B plus. Debt to cap is high at 66.7, but I like because this company is still like a growth company, so they're investing in new technology and whatnot, new software, because it's an application software company from Canada. And you can see here the dividend yield at 3.32. If we put the price back into the chart, and you can see here the stock for the most part trades between 10 to 15 multiple, and we're getting it at over 7 multiple. So we could double. If we were to go back to a 15 multiple, is a huge rate of return. So I was like, man, let me buy more shares. I owned shares before. I just added more shares to with my current purchase, because I bought a lot here around the $29, $30. So right now I'm just up a few percentage points. With the new buying, it increased my cost basis. But if it gets lower to $25, I'm going to be buying more, because the dividend would increase maybe around 4%. And then look at this earnings yield, 13.54, which is outstanding. So if the company, it would shorten this time frame right here, the company were to revert back to a normal multiple of 14, you can see here we have over 40% annual rate of return for the next few years. So I'll take my chances there. It's a good quality company. They've been growing dividends for since 2014. You can see here, and the growth's been pretty good, double digit. You can see here 15%, 15, 14, 15, 10, 11. So double digit growth since 2015. So that's outstanding. I like that a lot. Analyst scorecard are pretty accurate. You see the 1 year either 75% hit, or the company beats it 25% of the time, and 2-year forecast is a 92% hit. So they're very predictable. And if we go to the long-term forecast, and you can see here, they have here one analyst expecting continued growth in about 9.4% earnings growth for the next 5-6 years. So you can see this is why I like this company a lot. And if we go back to here, free operating cash flow covers the dividend, and I think free cash flow as well. You can see here, so cover the dividend. So the dividend is very well covered with this stock. So this is why I bought shares of OpenText Corp. And if we go to here, the Morningstar, it gives you the 4-star review, and this is last close at 48. This was done on April 12th, so obviously it's been over a month, and the price is at $30. So you can see here, even at this price point, it had it at a 4-star. So right now it's definitely a 5-star, with a fair value around 57, and that's where I think the fair value for the most part is, if we short in this time period around here, that's good. Should be around here, which is at the $50 range here, 49.67, and Morningstar gives it a $57. So $7 plus or minus, but either way, it is undervalued at the current price. All right, Morningstar, we go to the evaluation section here. You can see here price to sell is 1.39 versus the 5-year average is 3, so that's the indicator of undervalued. This here, the price of earnings, I'm not worried about this. This is a bad numbers they're getting there. Price to cash flow under the 5-year average, price to book under the 5-year average, and the PEG is extremely high at 6.5. This is 5-year average of 1.92. You like this to be 2.5 or higher. The higher the better. So I like that a lot. Operating performance, return on asset is lower than the 5-year average, which is not good. A lot of these indicators are lower. The trailing 12 months is lower than the 5-year average. This could be a good reason why the price has dropped. But what I like here is, earnings are expected to drop, but expected to pick up substantially in 2026. So if we look at the next stock, and then let's look at the charts here, why I bought more shares. So this is where it dropped after earnings this day, May 3rd. I bought shares here on May 6th on the Monday around here because of the big drop. I missed this opportunity here to pick up shares around under $28 or under $29, but right now it looks like it's pretty up. And the reason why I bought this, if we look at the 3-month chart, it's right at the 50 moving average here, right at the 50 moving, $32 to $30. This range right here, because it bounced here and it bounced here, and then we actually have support right over here, right over here, and right over here. So that's support, moving average, all good indicator of a bounce. That's why I bought shares. So now if it goes back, my next purchase price would be around this $26, $25 area. If it gets back down here, I will be buying more shares. So right now I'm just going to be holding what I have and see what happens. If it gets lower back here to $25, I will be buying more. And then at that point, I expect a bounce because price follows earnings, and earnings it's going down this year, but even at for 2025, even at that point, it still should be worth $40, $45. So that's why I bought shares. So the next stock I purchased is Amdocs. This company, you can see here, looks amazing. Just earnings continue to grow year after year, year after year, and they expect it to grow at double-digit rate for the next few years. So that's why I bought shares. And if we go to the chart here, I bought it right this day right here. Look at this bottoming tail. And I'm actually up almost 5% since I bought it. I bought it like around here. It was here 79.64, 79.64. So around here. I didn't get the low, but we got pretty close. And right now it's up very nice. And I bought it here because look at this. If we look at the monthly chart, you have support here right into the monthly moving average. You have support here. So that's why I bought shares around this under $80. I had my alert. It triggered. And I bought the shares because that's what I was waiting for. So I expect this company to continue to go higher because of the great support here. And so right now I'm up. I won't be buying anymore unless it does a pullback. If it were to go back to $80 again, I'll add some more shares because I like it a lot. Because this, if we go back here, the fast graph, this looks amazing. And you can see here, it's right here at 13 PE at 81.70 from yesterday's close, and I like it a lot. You can see here you have almost 18% annual rate of return for the next few years. It pays a nice dividend at 2.35, earnings yield is 7.6, triple B plus. Credit rating is an IT consulting and other services company. And so overall, you can see here, this is a great time to be buying shares of this company because it is undervalued. Over here, it went to $80 and it bounced all the way up to $90. Right now, we're back at $80. That's why I bought shares. And, you can see analyst scorecard is 100%. So they're pretty accurate in predicting this company's future in earnings. And you can see here, long-term growth continue to grow. So this is why I bought this stock. If we go to Morningstar, look at some of the valuation matrix. So you can see here, price to sell 1.9 is under the 5-year average. Price to cash flow under the 5-year average. Price to book right at the 5-year average. Basically not debt to equity. Interest coverage 18%. So great balance sheet. So this is why I bought shares of this company. So if we look at the operating cash flow, you can see here, dividends covered by operating cash flow, and free cash flow, dividends covered by free cash flow. So this is why I bought shares of this company. It looks amazing. It's still a decent buy now if you guys want to get into it. I'm no longer gonna buy at this point. I am gonna wait though. If it gets back to $80, I will be adding more shares. Maybe add another 10 to 15 more shares, and then wait and see. But I definitely like it at this level, the $80 range. This is why I bought shares at $80. So thank you guys for watching. I hope you guys enjoyed the video. Make sure to hit the like button and let me know what stocks you bought this week or planning to buy next week. I like to, have a dialogue with you guys on, the stocks we're buying and watching and things like that. So make sure to leave a comment in the comment section below. And thanks again. I'll see you guys in the next one.